Hello, everyone, and welcome. At the start of this year, the United Arab Emirates announced that its non-oil trade had surpassed approximately $1 trillion US for the first time in 2025. So at the same time, also, we're seeing the UAE signing several comprehensive economic partnership agreements, or CEPAs, and moving also into the implementation phase. So this has included Vietnam entering into force, and agreements also being signed with the Philippines and Gabon. And we're seeing a lot of negotiations progressing with the European Union as well. So taking these developments together, this may raise a larger, more pertinent question. Is the UAE scaling its long-standing trade hub model, or are we now actually seeing a clearer, more outward investment strategy taking shape across Asia and Africa? I'm joined by Saif Islam, our head of Asia forecasting, and Jed Brodsky, our country risk analyst, to unpack what this expansion really signals. Saif, let me start with you. So, from my understanding, India remains the anchor in the UAE's Asia strategy, but we're seeing major investments in elsewhere. For example, Vietnam's CEPA agreement entering into force, and the recent Philippines agreement being signed. Is now Asia shifting to be a more layered priority structure for the UAE, even beyond India?
Well, India is still at the center of the UAE's Asia strategy. It has a population of more than 1.4 billion people. It absorbs large volumes of energy exports and is deeply connected to the UAE through trade, investment, and financial flows. So the $200 billion trade target really reflects a relationship that is extensive and well established. But at the same time, the UAE is really intent on expanding its trade relations with other Asian countries. The CEPAs, which you mentioned with Vietnam and the Philippines, are facilitating structured access into Southeast Asia's manufacturing economies because these markets are embedded in global supply chains for electronics, industrial components, and consumer goods. So the strategy here is becoming more layered. While India remains central because of its size and consumption base, the likes of Vietnam and the Philippines offer something different. And other Southeast Asian economies may sign similar agreements with the UAE down the line, with each country playing a distinct role, I would say, in trade, investment, and supply chain integration.
So, Saif, to be clear here, this is not just about expanding trade volumes, right?
Yeah, you're right. That because the pattern here suggests capital alignment rather than just expanding trade volumes. Because the sectors targeted by UAE sovereign investors, including AI, robotics, semiconductors, and data infrastructure, link directly to Asian production systems. So for example, India's digital and technology services ecosystem fits directly with AI and various software platforms. Vietnam is another great example because its manufacturing base aligns with electronics and industrial hardware. So generally, Southeast Asia sits at the center of global supply chain diversification. So my answer is yes, trade agreements create predictable access, and then capital can move alongside industrial expansion and digital infrastructure development. So in essence, I would say that the UAE's shift towards Asia reflects deeper integration into production and technology ecosystems rather than simply increasing the flow of goods through existing corridors.
That's very interesting, Saif. Thank you so much for those insights. Jack, let's turn to Africa. I think we may be also seeing some shifts in trade investment strategies. As we know, the UAE's Africa engagement has been described that has been focused through ports, logistics, and trade intermediation. But some of these CEPAs that we saw being signed over the past few months have focused on, for example, artificial intelligence and initiatives around digital infrastructure as well over the past year. Are we now seeing the widest sector targeting in Africa similar to what Saif described in Asia?
That's a really good question, Bilal. And I think the short answer is yes. It's a trend that's visible across several layers. Ports and logistics certainly remain part of the investment strategy, but they are no longer the exclusive entry point. The Gabon Agreement has opened longer-term access into sectors like mining and food production, moving above and beyond transit networks or supply chains. And looking further back, Egypt's Ras Al Hekma Agreement is another great example of this different type of scale and deployment. It's a project which involves direct equity participation into a large coastal development zone, which touches tourism, real estate, and infrastructure. And to me, that signals long-term asset ownership. Interestingly, also, the recently announced $1 billion Africa AI initiative introduces digital infrastructure into the mix, with capital moving into data systems, public sector technology, and digital services capacity. So the shift in summary is really from enabling trade flows to owning assets across property, resources, and digital infrastructure.
That's very interesting, Jack. But how is the UAE actually moving into a broader asset deployment across the continent? For example, here, is the model different from region to region? Is the UAE deploying capital differently in North Africa compared to West or Southern Africa?
Yeah, we've seen different patterns emerge across the various African regions. North Africa, for example, has absorbed large-scale sovereign-backed projects, and Egypt is a really good example of this, where capital has been deployed into multi-sector development platforms that are tied to macroeconomic stabilization and long-term ownership. West Africa, unsurprisingly, is a lot more resource-oriented, with engagement there centering on mining frameworks and agricultural production, supported by trade agreements that really enable market access. In Central Africa, notably in copper-producing markets, the interest aligns with industrial and energy transition value chains. Southern Africa tends to involve participation in more established mining and energy ecosystems rather than state-led development projects. And finally, in East Africa, there's a breadth of investment across different sectors, but energy and agriculture still lead the way in terms of total inflows. So really looking at these regions as a whole, there's no uniform template for Africa. The UAE is taking its time to calibrate by asset type and regional structure.
Those are great insights there, Jack. Thank you so much. And actually, thank you both for those really, really deep insights and thoughts. So, if the last decade positioned the UAE as a global trade hub, I think the current phase suggests a clearer external capital direction taking shape across Asia and Africa. Thank you, everyone, for joining us today. And as always, Pangaea Risk remains ready to support our clients as they assess how these shifts translate across markets and sectors.